Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into some of the patterns we're seeing with equity earnings and related as well to some policy implications related to the next administration, the incoming Trump administration. So let's jump into it. Basically, we're at the tail end of earnings season for the third quarter of 2024, meaning that in this case, most companies in the S&P 500 have reported third quarter results. And I guess a punchline would be that results have been positive, but maybe not quite as positive as might have been expected earlier in the year. So for example, third quarter earnings growth is now estimated to be just under 6%, so 5.9%. That's down from an expectation of 7.5% as of the end of June. That's what was expected when things were modeled at the end of June. The fourth quarter earnings growth is now estimated at 11.6%, so down from an expected level of over 14, even at the end of September. So still very positive growth rates, but not quite as good as had been expected a while back. Now, as it relates to earnings surprises, about 75%, so around three quarters of the companies in the S&P 500 have reported a quote-unquote positive EPS surprise, so earnings better than have been expected. And the aggregate sort of level above expectations is a premium of about 4.5%. And so that's a good number, but it's actually a little bit lower than the typical positive surprise, the one-year average being 5.5%, the five-year average actually being 8.5%, and then the 10-year average 6.8%. So again, positive, but not quite as much. It's always good also to take a look at full year. And what we're seeing is for 2024, their earnings growth is now estimated to be 9.7%. So think of it as three quarters are in. One more quarter to go. So there's you can kind of crunch the numbers, what's expected in the fourth quarter. And now that growth rate has fallen just below 10% at 9.7. And again, when we go back to the start of the year, the view was it was going to be just under 12% or 11.8% as a growth rate. Now, when we look to next year, this optimism around earnings growth is really maintained, where there's an estimate of 14.8% growth compared to an estimate when we started the year of 12.8%. So in the case of next year, people are a little bit more positive. Now, one thing about this work, this basically relates to individual analysts' work, and all that data gets aggregated up to these consensus levels. So honestly, most of these numbers don't yet reflect the at least now known implications or known effect of or outcome of the election. So what are the implications, right? So maybe people have been anticipating, hey, this might be how the election would have gone. But now that it's more clear, we're going to assume that analysts are going to be updating their forecasts. And on the margin, there's a general view that the many of those estimate changes might be a positive move. In any event, to get into a couple other concepts. So when it comes to why, it basically comes down to deregulation. And so essentially deregulation would translate to the idea of maybe reducing costs, increasing profits, and therefore, of course, stronger earnings. So take, for example, in the energy space, oil field services, if there are few regulations, there may be more consolidation that reduces redundancies, can reduce costs and improve margins. Or in manufacturing, maybe there's easing as it relates to compliance requirements. And those, for example, could be related to the environment. That may lower operational costs. So the company can either reallocate those resources or bring up their profits a little bit. Financials, there is likely to be fewer restrictions when it comes to mergers and acquisitions that will enhance profitability for financial institutions. And then a final example we highlight in this week's article is pharmaceuticals. So think of a more streamlined drug approval process that can lower development costs. It may accelerate time to market and maybe increase the potential for revenue. Now, one final thing I'll say, though, those are sort of tailwinds The one thing I would mention that it could be a headwind as it relates to the incoming administration is the recognition that that Trump is going to go hard with tariffs, really as a mechanism to negotiate new agreements with other countries. And that just introduces the potential for tensions in terms of foreign policy and our relationships around the world. That's important because when you look at the revenues for the companies in the S&P 500, you add them all up, over 40% of the revenues come from outside the U.S. So ultimately, having stable relationships around the world will be important. So that could end up being, anyway, in the near term, a little bit of a headwind. And in some ways, what we might think of is when we add it all up, some of these positives around efficiency might be offset by some tensions in terms of the sort of stressed international relations. And yet, when we add all that up, if it ends up being neutral, we're still looking, for example, at a growth rate next year that's quite strong. So again, I'd say overall, the takeaway from the earnings season in third quarter and the sense of what people are saying in terms of where we're headed is that things are positive. And that's important because markets have run up and their stocks in some ways are a little bit richly valued. So having this support of further earnings growth is super helpful to that. Anyway, that's what we wanted to get into in this episode. Thank you so much for listening, and we'll catch you on the next one. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.